Good afternoon, Quasar Markets Live. You have your host, Howard Greenberg, here with you for our midday look at the market. And so far, not that we didn't expect Steve to have it nailed, but pretty much a nothing burger, literally SPY and QQQs, both almost even on the day. Man, I thought I had it right. I thought it looked like we were moving up here, after the initial drop in the pre hours and at 9 o'clock. If we're looking at the SPY here on the hourly chart on the right hand side, in fact, I'll blow that up. You can see we really started to make a move and got as high as 556.61, challenging the highs of the pre-market open or the post-market close last night, however you want to look at that. But we weren't able to do it. We've pulled back down a little bit. If we look at the hourly chart, we can probably set in a Fibonacci here. And when we do set that up, what you see on the hourly is, once we made that move, we pulled right back up to that Fibonacci level of 0.226. We bounced up from there, but we weren't able to break back up over the previous high from the today. So that's what we're looking at so far. Does that area at 552.95 hold up? That would be what I'm looking at right now, on a hourly look at the S&P. From there, QQQ now up about 0.14, so QQQ trying a little harder. And again, if I blow up the hourly here, you can see here on the hourly chart, I definitely like should have ran that up further, sorry. There's bullish flag on the hourly chart. So again, if we can break to a new high of the day above 471.79, got a little bit of a bullish flag in front of us that we're looking at. So I'm not out of the races yet. I think I'm still in the game. I'd like to see us break to new highs here. If we do, I think we see a little run this afternoon. We've seen some power in the afternoon. No real nothing out. After PPI came out in job report, not really much from there. Haven't seen a whole lot of analysts stuff kind of going around. More talk about what happened yesterday than what's going on today, quite honestly. With that big move up yesterday. So, that's what we're seeing there. Same thing, Russell Small Index, same sort of similar look to the QQQ. VIX still 1784 again, pretty low there, in general. Gold has moved up. As we know, it has been at all-time highs here. It is starting to hit a little bit of resistance, definitely struggling here to get through. I think if we pull that off of here, take a look at what the RSI looks like on the daily chart here. Yeah, we can see RSI starting to kind of creep back up here. With gold, that's a heck of a run. Silver, even more impressive a run, up 3.77. And you can see again, it's approaching. Steve had talked about the fib levels here. If you took the downward move that we had here, it really had been playing within those Fibonacci levels. You can see that it bounced all the way back up, couldn't get through that level at 818 and 618 rather, and turned back down. But you can see how the fib levels have been holding here pretty well. Steve pointed that out on silver yesterday. Bitcoin 57,625. So we're not seeing a whole bunch of movement there. Again, we're day range, we're sort of consolidating over the last 4 days. Again, for me, not something that's necessarily bad news. RSI right at sort of the midpoints here on the daily chart. When we look at the hourly chart, you can see we've been sliding back since hitting a high, a 58,560. We've been sliding back down. But again, that's a pretty, on the hourly chart, I like how that linear regression's pointing. I wouldn't mind playing that off of this linear regression. You also do have the 200 MA here that's starting to swing back up. So that also tends to give a little upward push to the price action a lot of times. So we'll keep an eye on that. WTI and Brent both moving up almost 3%. In fact, WTI just broke 3%. So again, we're seeing oil get back up towards that 70 level. Had been down as low as 65 and change yesterday. When we start to look at the bigger equities, we all know we've been focused a lot on NVIDIA. NVIDIA continuing to rise today, 119. Did make it up to 120 earlier. So again, NVIDIA nicely making and completing that return here on the U formation, as you can see. It's now completed that. It might be trying to form a little heads and shoulders here. So that could be something to keep an eye on here as we move forward. You could have the start of a head and shoulders forming here on an inverted head and shoulders on NVIDIA's hourly chart. Again, Broadcom looking good today. Nice strength there, up about 2.36. Tesla, pretty even. It's been pretty choppy, though, today. You can see it had made a high at 231, dropped back down towards to the low of the day at 223 before recovering, and now we're sort of in the midpoint here. So we've got a little bit of chop. Does look like there on the hourly we might get the start of a little bit of a consolidation here for another move. Let's see what happens there with Tesla. Other stocks in the green today, Temu, PDD, their parent company, that's actually making a pretty good recovery here. Again, another one on the hourly that we see hitting that resistance zone here in that 99 spot. That it couldn't, that it started this downfall back on Tuesday the 3rd. So one to definitely still keep an eye on. Ripple has given back a decent amount of that chap. Again, another one, I'm sure that if we start to plug in the fib, from that move up, you can see that the 618 retracement here is about where we're at and bouncing hopefully from there. Made a big move up on news that Grayscale is going to do an XRP trust. So similar to the original Bitcoin trust or the Ethereum trusts, they're digital large cap trusts for accredited investors. ASST, asset entities, with a nice move up here today, about a 7.69 move. And then ones that we were talking about earlier this morning, GM, strong move up 3%. I mentioned that in pre-market after its partnership with Hyundai was announced. On the downside, Moderna, it does look like it's hopefully found a little bit of a bottom here, trying to move back up a little bit the last 3 hours, but down 17% on news that they have cut their R&D by 20%, and they're definitely, their vaccine usage is down. Medical Properties Trust, which we were looking at, and there's, if we look here on TradingView, it says that medical property trusts are trading higher after the medical REIT disclosed a global settlement with tenant Steward Healthcare System, its secured lenders and unsecured creditors committee. Settlement announced on Wednesday covers 23 hospitals previously managed by Steward, with 15 hospitals in Arizona, Florida, Louisiana, Ohio, and Texas already leased to new tenants. The agreement restores the company's control over its real estate and its relationship with Steward and allows for the immediate transition of operations at 15 hospitals to new high quality operators. So that news has definitely helped that bounce back today. Some others we were watching, we know that Kroger had some good earnings. It was funny in the early part of the 8 o'clock hour, we saw a drop on the announcement of good earnings. Didn't really make much sense. We talked about that earlier. Now we can see it bounce back and is up 5%. So, even a better move. If you had bought it after that dip, almost a 9% move to the upside before this retracement here. So, Kroger, as we pointed out, Signet's had a nice run straight from the morning. That thing hasn't really pulled back at all. It's given a nice run up. So another one that's good. On the negative side, we had Caleres, the footwear company. As it said, shares are trading lower after the company reported worse than expected second quarter results and lowered its annual outlook. The company reported revenues of $683 million, missing analyst consensus. So again, not a good look for Caleres, and they've gotten hit pretty hard here today. Others that we were watching so far are our pumpers on the day, GV, which is Visionary Holdings. That one is rather interesting, actually, because this isn't a micro pumper or pump and dump like we've talked about some of these others. They actually announced that they had gotten an $120 million investment from the Saudi investment fund. So, that has, spiked theirs. So this is more of a play on a thesis or on news rather than on technicals or on a volume pump and dump. So good to see that. On the other side of that, we are seeing some of those low volume pumpers moving today. We have this Osisco Development Corp up 113. Again, nothing more than a micro pump and dump. I mean, that chart is as ugly as it comes. But you can see how it keeps spiking on these volumes. See it better on the daily chart here. This one has that same look that we looked at with WHLR the other day, with Faraday, FIFE, where we see this, continued just absolute decimation of a stock. But at the same time, what you do see is attempts to pump the stock for some liquidity and exit liquidity. What I will say is that what you don't see a lot of times is where it actually, and I'll blow this up a little better so you can see, where you actually have one. No, actually it's still, you can still see, I'm sorry it was so small there. You can see that you're getting pretty much a diminishing return on each of these pumps. That's what tends to happen. So many bag holders that bought back, never mind, in the area up here, but so many bag holders that bought here, and then here again, and then here again. So as this tries to make a move, even if it does break out of that trend, as it approaches here, the amount of sell pressure will be immense. But another one of those micro pumpers, EGIO, we pointed out yesterday, or earlier in the week, had been a dropper when it went from 6 back down to 187. Had gotten below $1. It was one of the ones Charlie spoke about this, right? To keep its listing on NASDAQ, needs to spend X amount of days over the dollar mark. So we did see it get that pump that Charlie talked about, that you sometimes see there, where you doesn't look that big on this chart, but that went from 110 to 234 at one point, up over 100%, still up 91. Another pumper earlier today was Tenon Medical. On the downside, 99 Acquisition Group, which is now going to liquidate as their merger fell through. So 99 Acquisition Group said late Wednesday will not be able to complete its business combination with Nava Health MD and therefore plan to dissolve and liquidate. So we've seen that stock that had moved up, on that news now move back down and getting crushed down 91%. RYDE is another one that's just getting drilled today. I haven't seen any news there. Yeah, not really any news that would cause that I see so far. Fulcrum Therapeutics, they are just released that as they said, is going to suspend a rare muscular disease candidate after disappointing data from a pivotal trial. So they had a phase 3 REACH trial evaluating an MD muscular dystrophy drug, but it hasn't had positive results. So as such, they are now looking to stop that. So getting crushed today. So healthcare news has been in the news. We've seen some negatives. Another one was this ONCT's down about 57% today. You sort of need the daily chart. The hourly chart doesn't have enough volume. Another that's ending a clinical trial. So the shares are falling after that. So those are the ones that we've been watching today so far. Again, I am not negative on the day. I think that we will see a continued move in the right direction. That we will continue to see. Us go towards daily highs. So I do think we're going to continue to do that. I will be back at 2 o'clock with Steve to take a look and see who was right today. So that will be interesting to take a look at. And we're going to turn it on to a report I did on short selling. And,
welcome, everybody. I am Howard Greenberg, your
host
and
today.
Director of Education at Quasar Markets Live, and I'm here to do a deeper dive on short selling a stock. At Quasar Markets Live, we are looking to not only bring you the latest news on all the financial markets, but we want to help teach you how to turn that news into actionable trading ideas. History tends to repeat itself, especially in the markets. So the understanding the causes and effects that a short seller report might have on an individual stock, and historically, how have those stocks performed in the months or even years following the report could help guide your investing technique in the future. Today, I want to discuss short selling, what it is, and a basic example of how it works. We're going to talk about some famous or notorious short sellers and discuss some of their biggest plays. Why do some, retail and regulators especially, consider short sellers' reports a double-edged sword? Who is Hindenburg Research, and what have been some of their targets over the years? And what did they have to say about Super Microcomputers, SMCI, and how has that stock performed since the report came out? So first of all, what is short selling? Imagine you're at a crowded party and everyone is raving about a particular stock. The buzz is electric and the price is soaring. But deep down, you have a hunch. That kind of hunch that keeps you up at night. You believe the stock is overhyped, overvalued, and due for a fall. What do? Enter short selling, a daring move that lets you bet against the tide, and here is how it works. First, you borrow the stock. You actually borrow the shares of the company's stock from someone, usually a broker, with the promise to return it to them later. Think of it as temporarily renting those shares. Next, we sell high, hoping to buy low later. So we immediately sell those borrowed shares on the open market at the current high price. Cha-ching, you now pocket the cash from that sale. Now we have to wait for the fall. Now comes the nail-biting part. You hope the stock price drops, maybe due to bad news, disappointing earnings, or just plain market reality, whatever your thesis was when you entered the trade. Why? Because you plan to buy those shares back at a lower price. So now that happens, what do? We buy low and we return the shares. When the stock price indeed plummets, fingers crossed, we swoop in. You repurchase the same number of shares, but this time at a lower price. And finally, you return those shares to the original lender. After all of this, you end up either counting your profits or licking your wounds. The difference between the high price at which you sold the shares and at the low price which you bought back those shares is your profit. But beware, if the stock price rises instead, you're in the red, and those losses can pile up faster than a Jenga tower collapsing. Let me give you an example of how that would work. We're going to call this the Great Widget Short. Let's meet our fictional investor, Jane. Jane is convinced that Widgets Inc. is a house of cards. The stock price has been soaring, but Jane suspects it's all smoke and mirrors. So she decides to short sell it. What does she do? First, she has to borrow and sell. Jane borrows 100 shares of Widgets Inc. from her broker and sells them at $100 each. So she pockets $10,000. Now we have the waiting game. Jane watches the news, hoping for a scandal or a disappointing earnings report. Meanwhile, the stock price climbs to $120 a share. Now the fall. Suddenly, Widgets Inc. CEO tweets about an accounting irregularity. The stock tanks, and now it's at $80 a share. Now Jane comes through and we buy low and return the shares. Jane buys back those 100 shares at $80 a piece, spending $8,000. She returns them to the broker, who's none the wiser. And lastly, profit. Jane's profit, the $10,000 from the initial sales, minus the $8,000 it cost her to buy back the shares, leaves her with $2,000. Her victory dance would be on, and her hunch paid off. Selling short is like tightrope walking without a safety net, though. The rewards can be immense, but the risks, oh boy, if the stock defies your prediction and soars, you're in trouble. Margin calls when your broker demands more cash can haunt your dreams. So the next time you hear the crowd cheering for a skyrocketing stock, channel your inner contrarian. Maybe, just maybe, you'll find yourself short selling Widgets Inc. or its real world equivalent. In addition to the conditions I just laid out, though, there are other costs and considerations when shorting a stock. It isn't as easy as that math and that description I just gave. When it comes to short selling, there is a cost for borrowing those shares. The cost of borrowing a stock can be varied based on several factors, so I did want to bring that up and dive a little further into that. Your typical borrowing fee. On average, to borrow a stock from your broker, they're going to charge you a fee somewhere in the range of 0.3% up to 3% per year, depending on how many shares are there outstanding available to be lent out, what is the demand, that's its own market. These fees are applied daily, so if you hold a short position for an extended period, the cost can really add up and break into those profits. There are also fluctuations and extraordinary cases. You do have to keep in mind that the borrowing fee isn't fixed. It can fluctuate at any time based on market conditions, demand for that stock, and the available inventory. We saw this happen during the GME crisis, right? It was extremely expensive to borrow GME shares, which shot up a short squeeze. In extraordinary cases like that, the borrowing fee can even exceed 100%. Yes, you read that right. Factors like high demand or limited availability can drive borrowed costs sky high. So when you're doing this, you really have to have good risk management. As a short seller, it is essential to factor in these borrowing costs when you plan your trades. Remember that borrowing shares can be recalled at any time, usually by the brokerage. So, if you can't honor their margin requests, you're required to sell them or give them back those shares and close your short position at any time. And you see that happen. It's happened to even the biggest players. We saw it happen again to Melvin Capital during the GMEs. Stay informed. You need to always check the specific borrowing rates provided by your brokerage or trading platform. And if you're shorting a particular stock, you need to pay attention to those daily fees and any changes in the borrowing rates. In summary, short selling involves not only predicting the stock price decline, but also managing the costs associated with borrowing that shares. It's a dynamic game where staying informed and adaptable is the key. Remember, the market can surprise us at any time, so you got to keep that risk management strategy sharp and in place. I will also point out that short selling does require traders to look at individual securities or the market differently than traditional buy and hold investors. It's really a different type of mindset that you see. People who play this tend to be bears all the time. It's not something that just tends to be, one trade out of 20. These short sellers, this is what they do. They tend to short the same way that a perma bear is always, buying, they're always selling. So short sellers must be comfortable adopting an inherently pessimistic or bearish outlook, counter to the prevailing upward bias in the market. Especially right now, right? Everything seems to be going up, not necessarily today, but overall, we just hit, all-time highs in the S&P, the Dow, and NASDAQ. Short selling often allies with contrarian investing because short sellers focus on strategies that are out of the consensus with the most market participants. It's usually the outliers. When researching possible candidates for a short sale, traders typically focus on fundamental analysis of a company's financials to identify possible sources of weaknesses for the stock ahead, technical analysis of the stock's historical trading patterns, or building a case for thematic weakness that will affect a sector of stocks. Some traders will short a stock while others will short a market as a whole via trading strategies that involve exchange-traded funds, ETFs similar to the SPY, QQQ, and others. Also, some traders use short selling as a hedge to minimize losses on existing long positions in the event of falling prices. In fact, we talk a lot about this recently with the perma bulls out there that you should have some shorts in your portfolio. If you're just geared to one side too far, whether that be long or short, it's not usually a good idea. You should have some contrarian plays there. It says, while the steps inherent to shorting the stock are the same, the goal is somewhat different. Short selling as a part of hedging strategy will help protect some gains or mitigate losses depending on whether prices go up or down. What are some of the risks of short selling? It's very important to know those also. And the most obvious risk with short selling is that the price of the asset goes up when a trader expects it to go down. And then, to add to that, the longer you wait for a trade to become profitable, the more interest you must pay on your margin account, the more it costs you to borrow those funds, and the more risk you take on in the event the price continues to go up. You may also need to add more money into your margin account to avoid what's known as a margin call. As I mentioned earlier, at any time that you're not at a proper level, the brokerage can tell you that you need to return those shares and close out your position when the value of the securities in your account fall below a certain level. A final risk with short selling is what's known as the short squeeze, and this one can be the one that really can get you. This occurs when there's a price spike in a stock that has been heavily short sold, which puts pressure on the short sellers to close out those positions to minimize their losses. In doing so, those short sellers buying back the stock actually help spur further gains in the stock price. And that short squeeze is what we saw with GME, a little bit less with AMC, but those are, ones that you've seen that over the past. Tesla has caused a lot of short squeezes over the past where, these short sellers have been on the wrong end. Because of the associated risks of short selling and margin requirements, many traders want to steer clear of this advanced trading strategy. And a less risky alternative exists in the option market where you could buy put options, which give the trader the right, although not the obligation, to sell the underlying stock at the stated price later. This option strategy offers traders a way to bet on falling prices with fewer risks. We will discuss this strategy more in upcoming videos. So now that we know what short selling is, let's talk about some of the traders that have utilized this technique with great success. Although I will point out on a lot of these folks, they used it to great success, but they also have lost and gained fortunes many times over the years. In fact, the first person I want to talk to is really the grandfather of the short. That is Jesse Livermore. He's often called the Great Bear of Wall Street, and he famously shorted the stock market in 1929, correctly predicting the crash and collecting about $100 million, which today is worth about $1.5 billion. So quite a win for Jesse. With that being said, he made fortunes and lost them multiple times throughout his life, and he actually died penniless. So, it's not as easy as it seems, and a lot of times it takes a lot of bets for these guys to win one. Another person that would be known for this would be George Soros, who is best known for his incredible short sale of the British pound in 1992, an event that led to the pound's devaluation. He made $1 billion on that trade, and it was said, that George Soros himself broke the pound. It's one of the more famous short selling events out there, and he's one of the people who definitely haven't lost that money afterwards. John Paulson is another one of the handful of traders that capitalized on short sales against the subprime mortgages in 2007. And we're going to see that there's a few guys that actually did it. Not everybody was on that side. Otherwise, it wouldn't have been a crash in 2007. But there was more than just Michael Burry, and we're going to talk about Michael in a bit here. But John Paulson, profited from the crash of the credit bubble, and his hedge fund book profited in excess of $15 billion during that 2007 crash. At the same time, David Einhorn was another trader that played this contrarian view on the market to profit. He was one that was very critical of Lehman Brothers for questionable accounting practices, and as he predicted, Lehman Brothers collapsed during the subprime mortgage crisis. And of course, I would be remiss not to include Michael Burry, known as the main character in Hollywood's The Big Short, the movie about the subprime mortgage bubble that led to the crash of the credit markets and took down Lehman Brothers at the same time. In 2005, Michael saw the bubble in the subprime mortgage and what he saw there is that there was all these attractive teaser rates that people had bought, mortgages based on, and the value of those loans were going to go in the tank when the higher rates took over after the initial period. He actually convinced Goldman Sachs and other investment firms to create and sell him what was called credit default swaps against those holdings. And when the market crashed, his hedge fund Scion made its investors over $700 million and Burry over $100 million. And as you know, if you saw the movie, his investors wanted out and wanted his head for a while there before it all crashed down. And it shows you the amount of diamond hands you must have to be a short seller. It is not for the faint of heart. With that being said, with the tremendous profits that you've seen some of these short sellers make, somebody is always on the other side of every trade. And one of the things that you will hear a lot of, and you will see especially in the news, is, many retail traders on Reddit and Wall Street Bets and those folks, the majority of which tend to be permabulls, along with regulators and politicians that, feel the need to make sure that every investor is protected and feels that the, industry is against the little man. Not that I argue with that approach. I do think that, one of the greatest things that Quasar Markets and Quasar Markets Live is hoping to add is, insights and transparency into these markets to give the retail trader an equal footing to, the institutional traders. And most feel that the short sellers, and especially the firms that release these short seller reports, are only looking to make profits and therefore cannot be trusted. So, it's important that we discuss this skepticism. If we're going to discuss trading using these ideas, we need to look at this also. And there is definitely skepticism surrounding short seller reports. They can often lead to significant stock price drops, which can trigger security class action lawsuits. You see that happen a lot. But then what we also sometimes see a lot of is that these unscrupulous people that are doing some of this, and not some of the folks we're going to talk about today, but others, are using inaccurate or false information in these reports. And we've seen the Ninth U.S. Circuit Court of Appeals cast doubt on the reliability of some of these reports. And we've seen them throw out multiple class action suits that were brought based upon these reports, saying that the underlying information was incorrect or inaccurate. So what we have to keep in mind is that motives matter. And when the short seller publishes reports, their motivations do matter. The SEC watches these reports closely and has brought litigation against unscrupulous firms and individuals. And the other thing we want to look out for is unidentified sources and then the reliability of those sources. These short seller reports will often cite confidential sources. However, allegations based on these sources must meet specific standards to corroborate their reliability. So the courts really look at that, and they've scrutinized whether the sources are adequately identified and whether the information provided is sufficiently credible. Another thing is educational value and the impact that some of these reports have. From an educational standpoint, short seller reports can be intriguing. I love reading through them. I have here on the screen, you can see Hindenburg's, report on super microcomputer. We're going to read through it a little bit and talk about that. Even large cap companies can feel the impact of these reports. They've taken down some of the biggest in the game, from Carl Icahn that we're going to talk about, that Hindenburg went after, to others. There's also legal considerations. We want to make sure that the authors and publishers of these reports are ensuring accuracy and reliability in their sources, and it's crucial for that. In summary, short sellers reports are a double-edged sword that sometimes reveal critical truths. Other times, adding noise to the market, though. As investors, it's essential to approach them with a discerning eye and conduct independent due diligence. Don't just listen to the report, but then do your own research and confirm. Short seller reports can trigger legal battles, and companies face challenges in defending against them. The interplay between financial motives, credibility, and stock price impact is complex and often litigated. Remember, the stock market is a battlefield where information wars are fought, and short sellers play a controversial role. So now that we've gone over that, let's go over about some of the information that Hindenburg released when it comes to super microcomputer. I've basically gone through this big report here and taken out some of the big points that I've took from it. But basically, Hindenburg Research, who's a well-known activist short seller, published a report alleging significant issues within super microcomputer, who is a $35 billion server maker in Silicon Valley, and as it says here, that has ridden the wave of AI enthusiasm. The report highlighted glaring accounting red flags, undisclosed related party transactions, sanctions and export control failures, and customer concerns. Hindenburg took a short position in Supermicro stock, which has been profitable for them, and we'll see how profitable it has been in a little bit here. The investigation spanned 3 months and involved interviews with former employees and industry experts. So again, at Hindenburg, while they won't tell you exactly who they spoke to, they definitely state enough facts to give credible information, or to consider their information credible. In Supermicro's response, it took them a while to comment. They finally did discuss it today. And they said that it contained false or inaccurate statements about SMCI. It did not say what statements it was that it were wrong. In its first comments on the allegations, Supermicro said the report contained misleading presentations of information that have previously shared publicly. The company said it would address those statements in due course without elaborating. But it has had a very negative effect on the stock's price. Supermicro's stock has declined almost 3% immediately after it was released, and it dropped down to 547. But after seeing some recovery last week, it's now down at 452, and is down 29% in the last month. Something to really keep in mind. And despite a 93% rise in its share price this year, the stock has pulled back 60% over the past 6 months. In August alone, its shares were down 29%, marking their worst month since October 2018, and this is due to its deteriorating profit margins. They also pointed out, as I said, some accounting issues, and they brought up and like Supermicro said, some previously disclosed information, but in 2018 they were temporarily delisted from NASDAQ for failing to file financial statements. So what Hindenburg did is they tried to show a track record of improprieties or admissions by the company when they're dealing with the SEC, trying to say that this could be playing out again. Because in August of 2020, the company faced charges by the SEC for widespread accounting violations, including improperly recognizing revenue and understating expenses. And after paying a $17.5 million SEC settlement, Supermicro rehired top executives involved in those accounting mishaps. So, they're doing that. With that being said, Hindenburg, as I mentioned, has, a crossed, history. They haven't always been right. And so let's talk a little bit more about Hindenburg in general. They're a short-selling based activist firm from New York City. They were founded by Nate Anderson, and it has gained prominence for its fearlessness in targeting high-profile companies. They're not scared of anybody. And despite potential legal challenges, Hindenburg has regularly published influential research reports that impact share prices. And we're going to go and look at a couple of the ones that they hit and, how it hurt. We've gone over what short selling is, there, but we know it involves borrowing an asset such as shares and selling it with the expectation that the price will decline. And the goal is to buy back the assets at a lower price, pocketing the difference. Hindenburg's approach is to typically focus on companies that it considers, and it uses this word or this set of words a lot, a house of cards. Their research aims to expose vulnerabilities and overvaluation in the companies that they target, and they describe their mission as popping bubbles where they see them. A little bit about Hindenburg's performance is, according to Breakout Point data, Hindenburg has been a standout performer among short sellers. In 2022, their 10 short targets experienced an average share price decline of 42%. So again, they had 10 targets in 2022, and those, stocks dropped by an average decline of 42%. And then in 2023, they had 7 targets, and they went down an average plunge of 36%. So again, we're seeing that. They also had successful short calls already in 2024 versus U.S. biotech Renovaro and a Swiss-listed fintech called Temenos. So, we've definitely seen them do that. Over the years, we've seen some of the companies that they've targeted, and they've gone after, some of the biggest people out there, from Carl Icahn to Gautam Adani, who is, one of India's richest, if not richest person. A couple of ones that I took a look at here were in 2023, they wrote about Carl Icahn and his company Icahn Enterprises. And I have it up here on the screen, and it's pretty dramatic to take a look at, quite honestly. You can see they issued that report right here on May 2nd when the stock was trading at 50. And over the course of the next month or so, month and a half, that stock dropped all the way down to 18. So from 50 to 18. And then, it had a nice little rebirth. So Carl was able to convince people things weren't that bad. And it went up as high as 35. So about half of the drop that happened, it retraced. But what you'll then see is it's continued to fall. And right now, it's sitting at about 12.94 at some of the lowest in the 52 weeks. So again, this was trading at $50 when they targeted it, now at 12. So, they definitely, had a big effect, right? They wrote about how Icahn Enterprise alleging that it lured in retail investors by paying an unsustainable distribution, while Icahn masked details about his risky personal margin loans, which they suspected were sizable. And then in August of 2024, the SEC charged Icahn over allegations that he misled investors by failing to disclose his multi-billion-dollar margin loans, fining him $2 million to settle the charges. So, Again, a lot of the stuff that they do does tend to end up in charges against some of the people from the companies. Another one that they did here was Pure Cycle. Pure Cycle, they wrote about in May of 2021, alleging that the green recycling SPAC was an ESG charade sponsored by the worst of Wall Street. I do love their rhetoric. And again, you can see that stock went from 26 to 998 in a matter of a week. Again, like a lot of them, we see the initial bounce back. In fact, it broke back to a high above where they had called that short report. So, it did rebound, but what do we see? That over time, they proved to be correct. And this thing has gone down now to 5.76. It got as low as 2, again, from 25. 6 months later, the company's CFO resigned. In July of 2022, the company announced the resignation of its chairman and CEO, and who they had noted in their report had previously run 6 failed public companies. So again, Pure Cycle, look at that beatdown that they led to, and it's proven to be pretty right. Another one that I watched play out, during COVID was Nikola. Nikola was a darling to some when it launched. I mean, it went just in a matter of a few months from lows at around 300 all the way up to 2,800. But it's a real scary story after that, right? They come out in September of 2020, and they pointed out that, they released a report titled Nikola, How to Parlay an Ocean of Lies into a Partnership with the Largest Auto OEM in America, that with the help of whistleblowers called out a vast array of alleged lies and deceptions by Nikola in the years leading up to proposed partnership with General Motors. Among dozens of other issues, they pointed out that Nikola's promotional video meant to highlight the capabilities of its Nikola One semi-truck was nothing more than a truck being towed to the top of a hill in the Utah desert and then filmed rolling down, a claim the company later admitted. And I remember that. I remember watching that video and being so impressed, because I did think that EV semis, I mean, come on, we know with the price of gasoline, right? Everybody is complaining about it, that could be the future. But this was just nothing more than a scam. Nikola's founder and executive chairman, Trevor Milton, resigned from the company 10 days after they did the report. Months later, around December of 2020, private investigators claiming to be journalists attempted to discern the identity of key Nikola whistleblowers, offering a meeting under false pretenses. The whistleblower worked with the Hindenburg to turn the tables, with the founder of Hindenburg pretending to be the whistleblower and secretly recording the meeting with hidden camera and audio equipment, outing the investigators in the intended deception. After that, Nikola's founder, Trevor Milton, was subsequently criminally indicted in July of 2021 on charges of security and wire fraud. And in October of 2022, a jury found Milton guilty on all 3 counts of fraud and later sentenced him to 4 years in prison. The whistleblower's identity was protected until trial, during which he served as a key witness for the prosecution. Their work has drawn attention and controversy, especially when they name short targets and present evidence against the companies or individuals. And again, Nikola down from 1,600 to 400. And now that stock's trading at $6.17. So, you have to say they have pointed out some of them, and it's fascinating how Hindenburg Research navigates this complex landscape, that's for sure. And if we take a look at what has happened with SMCI, since the report has been announced, it was trading up around 628. It has dropped as low as 398, regained a little bit to 446 here, but again, 446 from 600 is a tremendous loss. You've seen a weekly loss of 14%, a monthly loss of 30%, and a 6-month loss now of 60%. So looks like where there is smoke, there is fire. We will see over the coming months. So that's a little bit about short selling, short sellers, some famous ones over the year, what these short seller reports look like, and what it happens to some of these companies after this, these reports come out. Thank you so much for joining me again. I am Howard Greenberg, your host of Quasar Markets Live and our Director of Education here. Have a fantastic day and good trading.